Welcome to TheoTrade. This is Don Kaufman doing the weekend update here on March 11th, 2017. First and foremost, let's give you a quick review of some of the action of the previous week. But more importantly, we're going to be very forward-looking in this particular session here, as we've got quite a bit of risk being displayed on the table for this upcoming week. Now, for those of you unaware, we're going to come into a week where, once again, there's an FOMC meeting. There is nearly a 100% chance of a rate increase, and that's according to the Fed Fund futures out there. So let's get right to it. So I'm going to start here on the SPX, which ended the week roughly at 23.72 and change. Now, what was expected of this previous week? So right off the bat, and I display this on almost a day-to-day basis now, but most definitely going to display this for the entire week. All right, right off the bat, let's go back in time for just a moment, okay? Again, today is March 11th. We're going back in time over here to March 5th. And the reason I'm doing this here is to display what was last week really expecting in terms of movement. And to see that, come right up over here and you'll see the week was expecting about a $20 expected move. So if you take a look at where we were, okay, last Sunday we were trading 23.83. We were expecting about a $20 move. Ultimately, what did we end up getting? $10. That's it, just a $10 move. So we fell most definitively inside of the expected move. And again, if you tune in throughout the course of the week, I was talking about this extensively. So looking at the chart here on the S&Ps, we sold off mildly. Again, a 10-point move over here. You know, people would get you to believe like it's the end of the rally. What? We slipped slowly into like a warm bath over here at best. There was no heavy activity. And moreover, there was even light options volume throughout the course of this week. We actually tracked about 20% below the norm in terms of option volume. Nevertheless, I want to show you something kind of interesting over here, and some questions continuously come up about this. So we're going to go and we're going to just pull up a quick chart, and intraday, we're going to do intraday 5 days, 10-minute. Okay. All you're looking at is the action of the SPX throughout the course of the week. Now, remember what I was stating is the SPX started the week at that 23.83. Okay, gapped a little bit lower on Monday, kind of bounced higher, all right? But again, if you look at that $20 expected move, and again, we started the week right at around 23.83. Okay, so we started the week right around 23.83, and we were looking at this approximately $20 expected move. Now, an expected move, it doesn't necessarily denote that we have to stay in a $20 range, right? It's a probability of expiring, meaning that that $20 range, we're supposed to be in the $20 range by the end of the week. And the bottom side of that range was right in this neighborhood right here, which was 23.63. We actually touched it, bounced, okay, touched it, crossed through it. Things almost got serious down here at 23.54. If you go much outside the expected move throughout the course of the week, okay, you can explode on one side or the other, meaning that, you know, again, that expected move is right around plus or minus $20. If you started to go substantially outside of what was expected, the market can literally throw a huge hedge into there, and the hedging will actually drive markets substantially lower, something I'm going to explain here momentarily. Nevertheless, we just bounced right back into it again, touched down literally to 23.63 again on, of course, Friday, and bounced off of it and closed the week, you know what, mildly off, all right, which was about a 10-point decline inside of the S&Ps. Now, throughout the course of this week, I've been talking so much about the expected move. You know, I think the proper thing to do right now, let's just cut to the chase. Let's look at the expected move now going forward. All right, so last week, it's in the books, it's history. We had a fairly low range week. Once again, we've had a lot of low range weeks. I mean, if you take a look at the S&Ps, okay, I know that this looks like the most explosive rally ever, but it was quite orderly, and almost every single week that we've seen lately, we've closed inside of what was, again, expected. the last time we did anything spectacular, you have to go back here to ultimately, zoom right into it, specific day. It was December 7th, and I've pointed this out before. That was the last time we made like a 3 standard deviation move. Now, where am I going with this? Hedging activity is driving markets, plain and simple. Hedging activity, it's not just driving the SPX, driving the entire marketplace, because the SPX, the order flow in the SPX drives the whole marketplace. Now, this is where I've been getting so many questions lately, like, okay, how does this occur? Well, let's just be a little forward looking for a moment. Okay, so now we're going to look at this coming week. Now, this coming week, got to be a little careful, because this coming week is a primary expiration. What that means in the SPX product is that expiration, all right, during the monthly options in the SPX, expiration, it doesn't happen on Friday afternoon. It actually happens on Friday morning off of the opening settlement. So the expected move, check this little guy out. The expected move is plus or minus $27. But then that's only till Friday morning. That's only till Friday morning. Now, the reason I bring this up, okay, does that sound like a lot to you? I don't know. Okay, you got to kind of do your homework here a little bit. Compare it to previous weeks, because I want you to know what you're about to get yourself involved in. All right, let me close up this left side bar over here. And what I'll do is, again, we just saw that this coming week, by the end of the week, we're supposed to have almost a $30 move. Okay, compare it to the previous week. So I go back to March 5th, and what did we see for the March 5th expiration? Remember, we were looking at like a $20 move. So the move is what? Okay, now again, if it ended on Friday morning, it was looking at a $27 move. You realize Friday's included, you may have close to like a $35 move being priced in this coming week, which is what? It's over 30% more volatile, than the previous week. Okay, so there's an FOMC meeting. How does it compare to the previous week before that? And you can start pulling data for the previous week. Just do a quick homework over here. What are we looking at? Well, the previous week was only like a $23, almost $24 expected move. Still not 27. And again, you have to remember that this coming week has almost a $27 expected move. And again, that's Friday morning. So back to the previous week, well, about a $24 move. Okay, do it again. Go back over here. All right, back yet another week. Now we're, halfway into February over here. Open up those 5-day options, $20 expected move. Okay, go back another week over here. Now we're actually looking again at kind of one of those, weird weeks that's a monthly expiration. And you can see, and this is a shortened week this particular week, because it only had 4 days. There was a holiday in here. It had a $22 expected move. All right, go back one more week. Again, I know that this is, mind numbing, but if you don't do your research and you do a little bit of homework here, you'll find out that at no point in the last few weeks, okay, now we're, over a month back in data, we haven't had an expected move nearly the size of the expected move that we're seeing moving forward. So something, okay, is at risk over here. What's at risk? It doesn't matter. You can go, oh, it's the FOMC announcement. Listen, markets use announcements as catalysts. Whether the announcement means anything at all, like there's almost a 100% chance of, Fed funds bumping up a little bit. So who cares, right? What you have to look at is the announcement, right, is more like, oh, we have this pool of gasoline out there and somebody's throwing a match at it. And that's the way it appears to me, because the point I want to make with this, if you look how the week lays out, let me tighten up the number of strikes in here, but if you look how this week kind of lays out, here we actually have, options that are going to expire Monday. They have like an 8% volatility, but the options that expire Wednesday, this is the day of the FOMC announcement. It's not even 11 vol. And all of a sudden, okay, why on Friday are we up to like almost an 11.5 vol? If the FOMC is really going to be the, the spark behind what could be a fire, then why is all the volatility packed into like Thursday and Friday morning? I don't necessarily have an answer for it, okay? And I got one other interesting thing to show you. You can look at the spiders, and the spiders will actually give you the full week, meaning that the spiders, they do expire on what, Friday afternoon, and they're pricing in a $3.25 move, which is roughly speaking, that's the equivalency of about a $32 move inside of the SPX. That's a big tamale. in comparison to what we've seen recently on a 12.5% volatility. Okay. Now, I don't see a lot of other signs of risk in here. You know, the bonds, they've been getting clocked lately. I mean, okay. You know, if the bonds were rallying, okay, that's a sign of risk, you know. The volatility futures, what are those little monkeys doing? Nothing. They're always going down. I mean, I want to show you something interesting about the volatility futures. You recognize this week, the volatility futures slipped ever so slightly. Not a lot, but they slipped down this week. And the volatility futures I'm looking at, it's the VX J7. I'm looking at the J7s now because they got a little bit more time. If you're not familiar, the J7s, they have almost 40 days left. And the volatility futures slipped down and the market actually sold off a little bit. So the volatility isn't displaying anything. Okay, but the short duration volatility in the SPX is a little bit pumped up. Okay, I'm telling you, you got to approach this next week very, very cautiously. The only sign, okay, of, I would say, a little bit abnormal amounts of risk would happen to be inside of the skew. The skew has been elevated for a tremendous amount of time. It remains elevated. Okay, so we're all clear. Skew has only been tracked for a few years. Like, this is not like a long running like index. It's the out of the money puts versus the out of the money calls. Okay, and skew started in, you know, right in the neighborhood of about 2011 when they started tracking this. But we're at a higher instance of skew right now. We've recorded more high days of skew than really at any other time. Does that mean the market's going to, you know, crash and burn? Absolutely not. What it does mean, though, there is demand for way out of the money puts inside of the SPX. Okay, and that's something to keep in mind. Now, part of the thing I wanted to get to here is I keep getting all these questions. How, Don, does the SPX move the entire market? Well, first and foremost, look at some of the contract size and some of the open interest in here. First, you know, people always ask me, does open interest, does it move the market just because there's more open interest at one level or the other? Okay, that theory has been largely disproven in markets. Okay, it's called the Max Pain theory. It's been largely disproven. I've read a lot of white papers about it, studied it quite a bit. So heavy open interest doesn't necessarily denote that we're going to move to a particular area. But in the SPX, you have to realize the SPX accounts for this monstrous amount of the size of options that are traded every day. Okay, the easy way to say this, go to the bottom of the screen. The SPX on Friday traded 1.1 million contracts. Okay, it traded 1 million contracts. The entire options market did about 16 million contracts, right? So the entire options market does 16 million. So the SPX does 1/16 of the total volume. But the problem is the SPX is a $2,400 product. So think about that for a second. You know, what else is trading a lot of contract size? Apple? Apple's a $140 stock, you know? So the SPX is on a scale of 20 to 30 times larger. So when I talk about money moving, it's all the SPX. And then you realize there's other products that mimic exactly like the SPX, like the spiders. And the spiders do almost 3 million contracts. Between the spiders and the SPX, that's 4 million contracts. That's 4 million contracts. That's 1/4 of all the size inside of the entire options market is be done in the spiders or the SPX. You know, if you look at the VIX too, the VIX is directly tied to this. All right, we having fun yet? Okay, so if you look at the VIX is the what? S&P 500. Well, that's accounting for another 500,000. Just goes on and on. So like almost all the volume that trades out there in the marketplace has something to do with the SPX. Now, why does the SPX drive the marketplace? Why does it really drive order flow? Okay, for this, imagine you were a big trading firm. Trading firms today, and this could take a few minutes, but it's worthwhile, right? Trading firms today are predominantly doing net neutral trades. What net neutral means, okay, if you think about their risk, like let's say this is their risk, all right, which means they want to fall right here, okay? That's just a risk graph. So if we start, you know, coming up here, what do? They hedge, they hedge, they hedge, they hedge. If they start coming down here, they hedge, they hedge, they hedge, they hedge. I'll explain this in a moment, okay? But they trade net neutral, meaning they don't want to take a lot of directional risk. And what these firms do is they hedge dynamically. That means with the dynamics of the market. If the market goes up, they're hedging. If the market goes down, they're hedging. So they're always trying, okay, if you will, like here is a firm's risk. This is a trading firm, a proprietary trading firm. It could be Goldman Sachs, it could be Bank of America. Here's their risk. Think of their risk as one large ball. Okay, there's their ball of risk. And as the market moves, this ball starts to roll, okay, to one side or the other. What do? If the market moves up, they go hedge, 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 because they want to keep the ball neutral. If the market sells off, they go hedge, 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 hedge. And they have high frequency computers to actually keep them hedging. Now, I'm actually going to go to the Analyze tab, and I built, okay, a risk profile for you. Let's imagine that you were looking at this position, and this was some big, huge trading firm's position. What is this position? Well, let me elaborate a little bit, because I'm right now, hey, let me let you guys in on a secret here. You're going to feel like Alice tumbling down the rabbit hole. Hopefully that's all right. But for the most part, these firms, they go out, okay, and let's say that they sold 1,000 lot of straddles in the SPX. Okay, that's not uncommon at all. I mean, listen, you go look at the contract size in there, 1,000 lot is nothing. Nothing. Okay. And when they sell 1,000 lot of straddles, what they will do, okay, is collect. First of all, they're collecting a ton of premium every single day. This is just a short term, like weekly straddle. They collected like $22 on this thing. Look at the theta every single day. It's huge, man. Like their theta, that's the amount of decay in the straddle every single day. So the firm is collecting almost, like 200 grand in theta, but then they have this monstrous amount of directional risk. So what the firm does, okay, is they buy and sell S&P futures, okay, to hedge the risk. And the firm actually uses like high frequency boxes to do this. And they'll go out there and they'll just sell 200 futures. Why do they sell 200 futures? Okay, because it'll flip this risk around in a second. We just want to make a quick point with this. So this firm, all right, sells, for instance, 100 futures. They sell 100 futures. Do they sell all 100 at a time? No, they just fire them one at a time. I mean, if you have high frequency boxes, come on, you could fire one sub-second. And these firms can fire now in millions of a second. Millions of a second. Data is recorded now in billions of a second. So they buy and sell S&P futures against their SPX positions. Okay? And let's say they have positions in SPX and Apple and all of it. They just use the S&P futures to hedge the whole thing. Okay? And then they just collect their theta and they try to go home happy over here. It's a pretty big margin requirement though, huh? 27 million. Anyway, if you have, okay, firms that are hedging in this manner, which almost all of them are, it's dynamically hedging. What it does, okay, is for the most part, it has tendency to lock the market into defined ranges. Those defined ranges are something we call expected move. We just talked about expected move a moment ago, and we saw the expected move for the week, was right around $27. Well, this firm, okay, sold, for instance, the other day, this strangle or straddle for $22. And they're going to hedge this thing to the best of their ability. Okay. There's another firm that's probably on the buy side of this exact same trade. So you see, if somebody sold 1,000 straddles, there's another firm that had to buy 1,000 straddles. You're like, I wouldn't want to do that. Why? Why not? They've got hedging devices, even if they're negative theta, they got hedging devices that can deal with this. But the reality is this. If one firm's in the sell side, which they most definitely are, and there's another firm on the buy side, which they most definitely are, for every buyer there's a seller, they both, okay, one basically had a, $22 debit, the other one had a $22 credit. The funny thing is the hedging will likely drive the market, all right, up or down to the amount of whatever they basically traded this thing for. In this case, it would have been about $22. Think about that for a second. And when we move to the edge of the $22 movement, up or down, one firm kind of like, okay, I'm in a happy place right now. And they actually meet, okay, at the edge of risk. So what's happening in markets these days is these expected moves are, for the most part, the edge of risk. When I say the edge of risk, again, it's just like we displayed inside of that straddle. Okay, you actually move and migrate here and you find this happy place. And what is a happy place? It's a place where both firms are like, oh, wait, we don't really have any risk over here and we don't have any risk over here. Okay. But here's the crazy part. As long as you stay inside of the expected move, everybody can kind of go home happy. Yes, one firm is buying the straddle and they're scalping it off against it. It's called gamma scalping. The other firm is short the straddle. They're collecting the theta out there. Here's the crazy part. If we move outside what's expected, things can get nutty in a hurry. Why? Because then they both have to continue to hedge in monstrous amounts. And that's why markets, as soon as they come outside that expected move, they can start to make these 3 sigma moves. What's a 3 sigma move? It's 3 times the deviation. If you think about a 3 deviation move, okay, we're staring down the barrel this week of almost a $30 move is expected throughout the course of the week. A 3 deviation move with $30 multiplied by 3, you'd be looking at plus or minus a $90 move. And that's something that you need to keep in the back of your mind every single week right now. All we keep seeing is 1 deviation move, 1 deviation move. We just keep moving inside of what's expected. I just showed you on a chart a little while ago, okay? You just keep doing what's expected every week. The last major move we made was December 7th. That was a 3 deviation move. That week was a 3 deviation move out there. Every other week has been inside expected, inside expected. So all we're doing is here marking time between 3 deviation moves. Think about it with this coming week. Again, you have an FOMC announcement. But frankly speaking, I think the market's using it as nothing more than a catalyst out there. There's also been a little bit of slippage inside of financials. This is the product you got to keep an eye on throughout the course of the week. Financials, this is make or break right here. They've seen some expanded ranges throughout the course of the week too, meaning that, hey, we're starting to move in those financials over there. They break down, the market comes along with it. Thanks everybody for joining us here at TheoTrade. I'll be back on Monday, all throughout the course of the day in the TheoTrade chat room, and I'll also update you on Monday evening in the Theo Night video. Have a great weekend. Bye-bye.